Morning, everyone. I just thought I'd let everyone start dripping in. We'll wait for a minute or so until we have a few more and we tick over our time. All righty. Look, that's clicked over 10. We are sending a recording of this as well after if people aren't able to register, but I do know that everyone's time's quite precious, especially at the morning, so I will kick us off. Welcome everyone to our webinar this morning. Thank you for joining us. I would like to start this morning by acknowledging the traditional owners of the land that I'm coming to you from today, which are the Yagara and Turrbal people. And I'll extend that respect to all Aboriginal and Torres Strait Islander cultures. My name is Alice Ruhe, if you're not sure who I am, and I'm the Managing Principal here at the Ruhe Group. I'm also a registered trustee in bankruptcy and a registered liquidator. And so this world of insolvency is one that I float in all the time, but always understanding that it's not everybody's, daily drive. And because of that, which is a good thing, but it's because of that we thought we'd pop this webinar on today to really look at the Indicia of Insolvency, which is something that we just sort of call back to over and over again. But it might go to show some of our decision-making processes and some of the things that we think about when doing our investigations and really looking at the situation that a company can find itself in. So basically today we're exploring one of the most enduring and practical insolvency frameworks in Australian law, which is the 14 Indicia of Insolvency arising from the water wheel or the Plyman case. Now that was laid down about 20 years ago now and provided a context against which the slippery notion of insolvency could be assessed. This was quite helpful. Given the definition that we generally work off is that in the Corporations Act, which provides that a company is insolvent when it is not solvent. So not entirely helpful there. But we do know that solvency, is being able to pay your debts as and when they fall due. But sometimes we struggle with what that practically looks like. And more so when a reasonable person should start having second thoughts. And it's really that reasonable person test that we do draw on a lot of the times when considering whether there's further action to be taken. Many of us have learned these indicators years and years ago, but when a lot of our juniors today or other people that we're dealing don't really remember a world with checks in it, so let alone dishonoured checks or post-dated checks. And this is when I start to feel really quite old. Plyman talks about COD terms and a few other things that can start to feel a little bit outdated. But the behaviours identified by the court, they haven't disappeared. They've simply changed form. We might be looking now at post-dated checks being sort of promised EFTs, dishonoured checks being failed or direct debits. Cash on delivery terms might now be supplier portal lockouts before goods might be released, which is generally happening more and more. So when is that indicator there that we're really looking at from a solvency point of view? So today's webinar is not only about working through the 14 Indicia of Insolvency, as outlined in the water wheel case, which is really the starting point for all of our insolvency investigations, but also translating these historical indicators into more modern commercial life so that we can recognise them a little more easily and more effectively today. I am happy to take questions as we go. There's the Q&A has been enabled, so pop them in there if I see them. I think Liz is also keeping an eye out on those. If you want to pop anything into the chat, I will give you a reminder as well, sort of a couple slides from the end, because I know that there's always that awkward waiting space for people if they're wanting to pop their questions in, if there's any questions for the end. And I'm also, as always, happy to talk offline in relation to specific matters, just general matters today, please. So today we'll have a look at the practical side of these things. We'll look at why the indicia remain important. We'll briefly revisit the legal test for insolvency. We'll work through the water wheel framework itself and discuss what each indicator looks like in today's business environment. And we'll finish with a couple of practical case studies and some guidance on what directors, advisors, and creditors should do when there's multiple indicators that start coming to the fore. As we work through the session, I'd encourage you not to think of the indicia as a checklist, which is quite ironic because I will actually give you a checklist at the end, but more as, it's funny, everyone's talking about the castle at the moment because it's been about 30 years since that came out. And it's really quite, it's quite relevant here because it is the vibe. It's sort of, you need to look at, okay, well, how many of these indicia are obvious or are present? Are they increasing or decreasing? And what's the overall vibe and circumstance that a company finds itself in? So it's not that all 14 indicators need to be checked off before you can declare that something is insolvent, but one or two here and there may not actually be a relevant indicator either. So I think it's about understanding the situation as a whole, understanding looking forward, what that might turn into, and understanding what we're in at the moment compared to historical times as well. So again, we have this framework, which is hopefully a little bit helpful in terms of how we assess that. But as you can see, it is a slippery definition and something that really we need to nut down quite diligently to pinpoint those dates. You'll often find that in liquidators' reports or administrators' reports, we'll talk about a range as well. It's not, that it might be as insolvent as early as this time, and often that time might be the end of a financial year or an end of a reporting period, because that's where we can actually crystallise the information. But generally, there's not one date that it will happen. There's a range of time, and we need to try and identify that date. So if we think of all of these sorts of indicia as symptoms, one symptom might not tell you very much, but several symptoms occurring together will normally tell you that there's a much bigger issue developing and when you maybe need to start asking for help. So why does it matter? One of the biggest misconceptions, I think, about insolvency is that it does happen suddenly and on a date. But in reality, most insolvencies develop progressively. The warning signs often emerge gradually. A supplier might be paid a little bit late. The ATO is pushed back another month. A payment plan is entered into. That payment plan may not be met. A key supplier reduces terms. Creditors chase more aggressively. The legal correspondence starts arriving. And by the time a formal appointment occurs, many of the warning signs have often been present for months and sometimes even years. The strength of the water wheel indicia is that they help us to identify those warning signs much earlier. They're useful for directors deciding whether continued trading is appropriate, because we all know the implications of insolvent trading and the personal liability that can be raised because of that. They're useful for advisors assessing financial distress and when maybe to ask a few more questions or when to refer your clients on to a more specialist practitioner. And they're useful for creditors trying to determine whether their customer simply has cash flow issues or whether there's something a little bit more serious that's underlying all of that. So before discussing the indicators, it is important to revisit the legal question that we're actually trying to answer. In Australian, insolvency is principally a cash flow test. The question is whether or not the company can pay its debts as and when they become due and payable. So importantly, it's not purely a balance sheet exercise. A company may own significant assets and still be insolvent. That cash flow issue is really, and liquidity is really paramount. So the company may be generating strong revenue, but it may still be insolvent. A company may be growing rapidly, yet still be insolvent. And the issue is always whether the resources can be converted into cash quickly enough to meet the existing obligations. And this is why behaviour matters. Payment behaviour, creditor behaviour, supplier behaviour, and lender behaviour, they're all indicators in this concept and framework. So the water wheel indicia focus on those practical realities. The Waterville case remains influential because it converted a legal concept into an observable business conduct. Rather than asking abstract questions about solvency, the court identified practical indicators that tend to appear when financial distress is developing. And importantly, the court didn't suggest that one indicator automatically proves insolvency, but instead insolvency is determined by considering the totality of the circumstances. As I said, it's the vibe, like they talk about in the castle. The more indicators that are present, the longer they persist and the more concerning a position becomes. So think of it a little bit like a medical diagnosis. One symptom might be nothing, multiple symptoms occurring together create a far more clear picture. And that's how these indicia should be used. So at a glance, these are your 14 indicia. I'm not going to read every indicator on this slide. We'll go through them all separately, but I want you to notice something. Every indicator almost falls into one of 4 categories: financial performance, funding and finance, creditor behaviour, or information quality. And so when businesses move towards insolvency, pressure generally appears in one or more of these areas. As we work through the indicators, think about which category the behaviour falls into, which can help identify the underlying causes rather than simply treating the symptoms. So we'll kick off with losses and liquidity. Continuing losses and liquidity problems are the first 2 indicators, and they often appear together. One of the most common statements we hear from distressed business is, "We've never been busier." But activity is not the same as profitability, and profitability is not the same as cash flow. And I know I'm sounding like I'm talking about a lot of accounting terms here, and we have quite a few non-accountants on the call as well. But it's important to understand the difference between these things when we are assessing business performance. I've seen businesses increase sales by 20 or 30%, but still move closer to insolvency because their margins have really collapsed in. The business may be funding losses through creditor debt, tax debt, or director contributions. Liquidity creates similar concerns. So current liabilities can begin growing faster than current assets. Creditors age, stock can't be converted fast enough, or they have too much, or they can't get enough. Work in progress remains unbilled, and the business is effectively borrowing time from creditors. And this can be cumulative, as we'll see a little bit later as well. But these are classic sort of early warning signs. And the ideal thing is at this point in time, things can be done. When we're looking at these things and the business is busy, but there might be issues around stock conversion or WIP conversion or even debtor collection, things can be done. Striking cash flows, looking at, where the seasonality is, reining in costs. This is where we like to see companies that may be on the edge of distress, because there's really, at this point in time, quite a few more options than there might be as we continue to sort of filter through the timelines and the indicia that we have. Now, I don't think it would surprise anybody to learn that tax debt is one of the clearest distress indicators in a modern insolvency. Many businesses effectively use the ATO as a working capital facility. They'll pay rent so they don't get evicted. They pay their wages so they have people turn up to work. They pay suppliers so that they have their stock, but they tend to defer their BAS, PAYG or super. And initially this can seem manageable, but the problem is that the tax obligations don't stop. So new liabilities continue to accumulate each quarter or month, depending on how the reporting system works. And eventually the business finds itself paying historical tax debt while new tax debt keeps arising. I would be really interested, and I haven't heard anything anecdotally yet, about how businesses are dealing with payday super and how that has maybe become a really early indicator now of the cash flow constraints and solvency issues in a business, because I think that's what it's there for, is so that a business can understand its obligations constantly and that they are real obligations. But I think that there's going to be a lot of businesses that are impacted if they haven't prepared appropriately for that. And I don't think we've started to even see the fallout from that yet. So one failed payment arrangement, it should immediately attract attention, even though it's just one thing. It's not because of the amount involved, but it can suggest that the company couldn't satisfy its own proposed payment plan. And we'll talk about some of the tax officers' perspectives in a moment as well. I was lucky enough to be on a call last week where we had a bit of an update there. But it's really important that that sustainability of payments is something that is demonstrated and that is continuing. So when we see significant tax arrears, we're really seeing evidence of a business that is struggling to fund ordinary recurring obligations. There's some updated information from the ATO, and we'll probably do a session on that shortly as well. But in short, the ATO is still sitting on, I think it's 58 billion of collectible debt. Out of that, 37.6 billion is attributable to small business. And the vast majority of that debt, about 27.1 billion, relates to activity statement debt. So in the period 1 July 2025 to 30 April 2026, the ATO issued over 68,000 DPNs in respect to liabilities of 3.9 billion. The ATO is also the largest creditor in most insolvencies. And whilst they only take steps to wind up a fraction of the total insolvencies going through, it's pretty obvious that unpaid tax can be a relatively strong indicator and an early indicator of insolvency concerns. So moving on to banking and funding pressure, here we're looking at the relationship that an entity has with its bank. And whether to preserve cash flow, an entity has gone outside its banking covenants to open an account with another bank to try and preserve cash flows. The date of opening or activity in this additional account can sometimes be a really good indicator for us of solvency pressures for the company. Because we do see it where sort of a company's banking facilities is all wrapped up within one bank, which means that there's generally an all monies clause caught up in there. And so we do see, and I've seen it on a number of receivership appointments actually, where a secondary account is opened outside the covenant by the company where they'll filter cash flow into it to try and quarantine that out from the secured creditors sort of overall environment, which is totally against what their covenants say and outside, you know, what the security enforcement arrangements that they should have with their secured creditor. So it's not, you know, something that at all should be done. But when it is done, when that happens, is a really good indicator to a liquidator of, okay, why did that happen? And was there knowledge of solvency issues? And why couldn't it continue to pay what it needed to pay as and when they fall due? So whilst it may seem like a good idea, it's really will come back and bite a number of times over. This can also be illustrated where a company seeks to refinance with another bank or lender and it isn't able to, especially when the secondary lender is a little bit further step away, I guess, on the finance schedule and even towards private equity then as well. So it depends on which lender the finance is being sought from, on what terms, what's having to be offered up in order to source that funding, and whether or not ultimately that funding is able to be obtained. Again, it's a whole raft of things that sort of fall within that same little gambit. So basically, other examples of finance pressure can extend to overdraft reductions, covenant breaches, requests for additional security, more frequent reporting requirements, or perhaps even a lender simply refusing additional funding. And the common theme is a loss of confidence. The same can apply to shareholders and investors. If existing shareholders are unwilling to inject more capital or investors withdraw from discussions after conducting due diligence, then these developments can provide important insight into the company's financial position. A particularly interesting modern sign also is directors funding operating expenses. So when directors begin paying wages or rent or suppliers themselves, it often indicates that ordinary operations can no longer be funded from ordinary trading cash flow. And it can just be seen as short-term liquidity issues, especially if things do eventually turn around. However, if these issues are present and there is no change to circumstance or how the company is doing business, then it really is a red flag that needs to be addressed. So I'll keep saying that none of these in isolation mean that a company is insolvent, but we shouldn't wait for all of them to appear either. And that's why it's important to identify these factors to address their risk as they come along. All right. Moving through to supplier and creditor pressure. Some of the strongest practical indicators come from observing how third parties behave. Suppliers are often the first people to recognise distress. Why is that? Because they live that payment history every day. So historically, we used to see that this was when the tap was turned on and off in relation to sort of cash on delivery terms. But today it might be seen as pro forma invoicing or account suspension or credit limit reductions, stock being held, until payments actually received. We see creditors being paid outside their trading terms, and that's an indicator that remains highly relevant. Just going back up to the stock being held or withheld until payment received, we see this a little bit now in terms of subscriber behaviour, where people are sort of getting put on to more subscriber arrangements, and whether that's in terms of their IT or whether that's in terms of their bookkeeping or accounting or other services where there's a monthly payment that needs to be paid constantly, and the tap can then be turned off if that payment is not made. So whilst it's great to preserve cash flow, preserve consistency in the cash flow, what's going to be paid every month, and it's a sort of annual payment spread over time, it can sometimes be that sort of one missed payment there too will actually cause the break. And I think that we're seeing that more and more sort of in line with the behaviours these days that probably replaces some of that COD behaviour previously. It also goes with the sorts of businesses that are around. We have much more sort of heavier professional services, IT, e-commerce base now than we probably had 20 years ago. So there's different examples across different industries. So a creditor who routinely gets paid 60 or 90 days late is effectively financing the business, especially when themselves have a 30-day payment terms for their suppliers, which then again snowballs because a company's failure to pay within payment terms can actually impact the solvency position of that supplier. I've said for years that people don't use debtor insurance as much as they need to, and I think that's something everybody needs to sort of get in touch with, get on board with, because it can really assist the client payment behaviour. Whilst it's not something that can be controlled at the supplier level, other than cutting them off or not dealing with them anymore, can really be a problem. And I think, we see a lot of it when insolvencies start, when contractors or subcontractors aren't getting paid because the next sort of client up the line is going under. So it can really snowball, this insolvency event. And then you can see the insolvency pressure across the different layers in that sort of business stream as well. So when we see increased creditor ageing combined with supplier pressure, it's often a really strong indication that cash flow strain has become systemic rather than temporary. And we used to see this when we took possession of the books and records, either in the form of unopened mail invoices, or the pay now sticker, or all the stickers across either the envelope or the invoices themselves. But we've now, in the vast majority of instances, replaced this with the emails from suppliers or on different portal levels as well, where they're following up those payments. We see a lot of automatic emails that have been sent. So, if one payment is missed, there might be a follow-up email that then might escalate in terms with, the email cadence. Then it might come down to daily emails. And so, again, what we sometimes see, because it is a recurring part of nature that we see directors sometimes having their heads in the sand on these sorts of matters, or not failing to engage with what's actually going on, that we actually, some companies, we see them change their email addresses or generate different areas of contact so that they can actually avoid the constant creditor pressure. So then again, for us, understanding when that account's set up and when the correspondence cadence is changed over to that new account can be a really relevant indicator in terms of when a director should have known and then decided maybe not to have addressed terms of solvency and non-payment in their usual sort of email addresses and those sorts of things. So just different ways that we're seeing those correspondence come through makes it increasingly important for us now to obtain, email servers and even portal access we're finding now too with different suppliers and creditors to see the correspondence and the communication that has happened, promises that might have been made, understandings about, where things are linking up, much different than getting all the mail that hasn't been opened or the, creditor invoice files that we used to many, many years ago. Helps with the books and records that we have in the office, I must admit. There's a lot less of those, but probably not as helpful in terms of those initial indicators. Rightio. So the two check concepts here that really probably aren't immediately as relevant, but they are in their own way, are the post-dated checks and dishonoured checks indicia that we see. So most younger business owners have probably never issued a check, let alone a post-dated check. Yet the behaviour exists everywhere. It used to be we'd walk in to a receivership or to a liquidation, and you'd open the drawers and you'd see whether or not there'd been either post-dated checks drawn or checks drawn but not sent. And that was a really heavy indicator of what may have been going on. But really a post-dated check was just a promise of future payment that may or may not clear. And today that promise might appear as an email saying, look, we've scheduled the payment, or the payment's been uploaded for approval, it should clear tomorrow. These sorts of promises, and even where they are uploaded into the internet portal but not paid, can sometimes be a bit of an indicator. So occasionally these statements obviously are true, but repeatedly making those statements can be a warning sign. Dishonoured checks have also evolved. Today we see failed direct debits or declined business credit cards, especially again on those recurring payments where you've got a subscription model or a direct debit set up. If the credit card returns non-paid, then that's it's not a big indicator, but it can be if it's happening over and over again and with a number of suppliers. We see rejected payroll files, electronic payments that never quite arrive. The technology's changed, but the underlying financial stress has not. And if anything, it should make it a little bit more obvious for directors and their advisors to identify that there's a problem, because it's quite clear either in the bank feed or in, the payables in Xero or what have you, in terms of payments that are being promised but they're not being paid. But as with everything, you need to make sure that those documents are up to date for them to have relevant information, and we'll discuss that as well in a second. But I think we need to sort of get across the fact that just because we don't have checks anymore, that these indicia don't apply. All right. Special arrangements with creditors, and this indicator is really quite important because it does often go unnoticed. Many distressed businesses survive through negotiation. The landlord might agree to a payment plan or even a deferral for a period. Similarly, the ATO might agree to a payment arrangement. They're not as common as they once were, but they still are available in certain circumstances. One supplier might receive weekly instalments, another might receive monthly instalments. A legal creditor might get a lump sum payment, and then we cross our fingers that there's no supporting creditors waiting in the wings. So viewed individually, none of these arrangements necessarily indicate insolvency, but collectively they do paint a very different picture. And the question becomes, can the company pay all of its creditors on its normal terms, or is the company selecting who gets paid and when? And this is causing more overall damage as time goes on, because the distinction is quite critical. It touches on the issue of preference payments as well, and the potential recovery of those, which is something to really be aware of. So the special arrangements with the selected creditors, especially who might be seen to be the important creditors, can be quite an obvious sign that maybe there is a little bit of distress going on under the surface. And of course, once the legal demands start to arrive, the pressure typically accelerates from there. We see letters of demand, statutory demands, and I mean, obviously that's super important to deal with as soon as, they're identified. Court proceedings, judgments, enforcement action, winding up applications, legal processes, they really matter because they introduce deadlines. Hope and optimism can't stop a statutory demand from expiring, and a winding up application may impact supplier confidence and banking relationships even before it's heard. These days, most creditors actually have alerts on their customers, either with Creditor Watch or something similar. So when a winding up application is filed against a company, they will get alerted. We'll often see that as well in terms of the ATO debt disclosure. So that's a whole other situation and presentation. But, once these alerts are made, there's some very, very good credit managers out there, and you'll find that a lot of the business systems get locked down pretty quickly, or at least put on an alert. So when legal pressure begins increasing, governance, discipline, and professional advice become particularly important and quite urgent. Number 13 is rounded sum payments, and it's probably one of the most underrated indicators, because when businesses are healthy, invoices tend to be paid in full and according to normal processes. Distressed businesses often start making strategic payments, $5,000 here, $10,000 there, $25,000 to stop a supplier cutting them off. The payment isn't concerned or connected to a particular creditor invoice. It's generally attached, actually, when you see it in the accounts, it's generally attached to when a debtor invoice is received. So they're hanging on. Someone pays a little bit of money off a debtor invoice, and then all of that goes out relatively quickly in round amounts to try and satisfy, a tranche of creditors that might be sitting there and applying pressure. So it's definitely connected to that pressure. And when the court recognizes that these payments often indicate cash rationing. So the business is no longer following a payment cycle, it's managing a survival cycle. And I think once you get to this point, it's quite important to really highlight, whether the company can satisfy its debts as and when they fall due. And you'd almost have to swing it on the other side to see what's there to prove that the company's solvent. Because once this is happening, the only reason generally it is happening is because there is a lack of cash to pay the suppliers what is due and payable at that time. And the final indicia here is the inability to provide adequate financial information, or the presence of poor financial information. And in my view, this is one of the most important indicators, because today businesses have access to more information than they ever have, but that doesn't mean they understand it, and that doesn't mean that it's the right information. And that's why it's really important for businesses to have great accountants and bookkeepers and advisors to actually tell them the story. I see, accountants, bookkeepers and advisors as really the translators in these situations, because the business owner or the director is really living the day-to-day of the business, which may not be translating. As we said earlier, the business might be really busy. There might be a lot of projects going on, but that does not translate into business success. And it's that understanding about why that's not happening that is really based on the financial information available and the discussions that can be had with the financial advisors to the company. So we've got cloud accounting systems, automated bank feeds, real-time reporting, cash flow tools, but we still encounter businesses that are unable, maybe unwilling, to produce reliable management accounts or forecasts. Directors sometimes tell us that they monitor the business by checking the bank balance every morning, but the bank balance is not a solvency report. And without reliable financial information, directors can't make informed decisions. And if directors don't understand their financial position, the risk of poor decisions rises significantly. So directors should know their figures inside and out, what's coming in, what's going out. Seasonality is a really big one. And I find that it gets missed so often because, we're having a great month this month, so it all must be going fine. But next month, either we've got your tax obligations that are coming up, or we have maybe a lot of people that are on leave, so they're not actually generating income, but we're still having to pay wages, these sorts of things that happen. So the seasonality in terms of cash flow is so important. And even those big once-a-year payments, that there needs to be an accumulation of funds in the account for. Again, most things now you can pay and smooth out, but big payments like insurance payments or levy payments or these sorts of things, they really need to be taken into account proactively, so they're not left holding the baby at the end of the day. Sometimes, it's not often, but sometimes it's actually not as bad as it seems if directors are able to provide their cash flow and budget forecasts. The directors can feel that they're under a certain amount of pressure, but when they actually map it out, there can be a reasonable expectation that their obligations are looked after, and that sort of pressure over their head is not necessarily, as bad as it seems. But we find that directors put this off because they think it is going to be terrible, and so they don't want to do it. And there's that sort of ignorance piece there. Really interesting way of thinking about it, but it's so important to have the information, because when you have it, even if it's not as good as it might be, you can adjust to that. You've got time to work towards that. You know what your cash runway is. It's often the uncertainty of the position that causes a lot of the stress, and the information available that allows strategic decisions to be made. I'm going to run through a couple of quick scenarios, but if you do have any questions or anything, chuck them in the chat now in the Q&A, and it's fine if you don't, because you can come to me later, or maybe I've just answered everything. I know that sometimes it can be a bit awkward on these chats as well, but I just want to give you the opportunity to do that, because I don't want to sort of just be hanging around at the end and someone feels obligated to do that. So if you're wanting to, go for it. If not, no stress at all. So in this scenario, we have the busy but broke business, where we've got a wholesale business that really has its sales increasing, but the margins are falling. The ATO is owed a substantial amount. Suppliers have reduced their terms, and the director is now funding wages. There's no reliable forecast. And if we only look at revenue, we might conclude that the business is growing and doing really well. But when you actually apply the framework that's set down in the water wheel case, a very different story emerges. There's clearly multiple indicators present simultaneous here. When you're actually looking at the BAS arrears, you're looking at the margin being down and the supplier terms being reduced. Now, that also might be the aged creditors could also be because the aged debtors are increasing. And that's something that really needs to be looked at as well in terms of collectability of debtors on these matters. So, we're looking there and we're looking at the different indicia available, and it's clear to see, that there's quite a few of them that are present. And then moving on to the situation I was sort of referring to earlier, sort of having a more digital business. It's a little bit different to those traditional businesses, 20 years ago that were being pushed through the insolvency process. But we've got, here, many people might assume that insolvency indicators apply only to the traditional businesses, but these cash digital businesses are really, they can be quite fraught as well. And the issue is, at the end of the day, there's often not a lot of asset bases that hold it together, that they can be called on. So this example sort of looks at a software company that may have no stock and no physical premises, but it still has creditors, it still has tax obligations, and it still relies on cash flow. So when maybe a payment gateway imposes reserves, the cloud provider can threaten suspension, payroll tax goes unpaid, and funding can't be raised. The same indicators are appearing as in a traditional business, but in different form. And this shows some real life factors. We have a matter at the moment where an online sales platform is actually holding back payment of funds pending resolution of a couple of matters. And so that is impacting significantly the cash flow, and the cash flow that's unable to then pay the funder. And so it is an actual real life example where you need to know where your funds are going and how you can actually get them out of that system as well. May not seem like the traditional matters that we need to look at, but definitely the vibe that overall, where is the cash going? Can we still pay everything that we need to? The worst response to financial distress is denial. The second worst is delay. And so where multiple indicators appear, management should improve visibility immediately. They need to update the records, preparing cash flow forecasts. And you know what? Those cash flow forecasts sometimes get down to, we think of a monthly forecast. It can come down to weekly and sometimes even daily forecast to look at where things are being paid, what's coming in, and how that needs to be monitored on that sort of cadence. We need to identify critical deadlines and we need to seek advice early. We need to document decisions carefully. The earlier an issue is identified, the more options generally exist. The later action is taken, the fewer options remain. I feel like I am a broken record when I say that because that is something I say constantly, but it really is the truth. Now, we have a financial distress checklist, which I know we just said we're not thinking of it as a checklist, but this is a checklist. If you're wanting to go through that QR code, it'll also be sent with the webinar when we send our thank you email around in a day or so. But this could be helpful in identifying and assessing some of the factors. So you can scan that QR code for access. And it just, I think, provides a good indicator as to, is it as bad as we think it is? Is it sort of okay? Is it worse than we think it is? And, provide some discussion topics on that. So if there's one thing I want you to think about today, it is this. The 14 indicia remain as relevant today as they were 20 years ago when water wheel was decided. The terminology might have evolved, the behaviours have not. So insolvency rarely announces itself through one dramatic event. It does sometimes, but it doesn't happen all that often. Instead, it reveals itself through patterns. The more indicators you observe, the more attention should be paid to the company's ability to pay its debts as and when they fall due. And recognising those signs early is really what preserves the options. So I hope that has provided some insight and some thoughts in terms of what insolvency is and what it looks like and what it means by sort of you need to take it all as a whole. And if you do have any questions or queries or anything you want to discuss with me, please feel free to reach out. Otherwise, I'll leave it there. You can get back a little bit of your time. I don't have any questions, so I'm very okay with that. But yeah, feel free to reach out if there's anything else we can help with. Thank you so much for coming along.